Hey everyone, welcome back to Corporate Decoder, the place where we help you understand the hidden stories in public company filings and prepare to decipher a financial move that might just be a game changer for Laser Photonics. Today we're diving into a recent filing from Laser Photonics Corporation, a company that builds and services industrial laser systems, something that might not sound exciting, but the financial maneuvers behind it certainly are. So what's the big news here? Well, on August 28th of 2025, the company announced a significant financing deal with a firm called Hudson Global Ventures. Specifically, they closed what's called a convertible note financing. This means Laser Photonics got some much needed cash, but in a way that could really shake up how their stock works down the road. Let's break down what this deal actually involves because it's a bit multi-layered. First off, they issued what are called commitment shares. These are basically shares given out to secure the deal, 41,800 of them to be exact. Think of it as an upfront thank you for Hudson Global's commitment. Then came something called a warrant, effectively giving Hudson Global the right to buy another 157,258 shares at a set price of 4.34 Than per share. Now, this warrant is good for 5 years, but there's a catch if their stock price ever drops so low that it's considered penny stock, and this is defined by SEC rules. Then they might have to pay the Black-Scholes value, which is a way to figure out the fair price of that warrant based on current market conditions. This hints at a potential concern about stock price volatility. The biggest piece of this puzzle, though, is the convertible note itself. Laser Photonics borrowed $455 million with this note. It's a 12-month loan with a 12% annual interest rate, and they're paying it back in monthly installments. But here's the kicker, it's convertible into shares of the company's common stock at that same 4.34 fund price. This is where things get really interesting for investors because a convertible note can act like debt, but also like equity. On top of all this, Hudson Global also has what are called piggyback rights. This means if Laser Photonics decides to issue more shares in the future, they can tag along and sell their shares too, which can be good for them but could dilute the value for existing shareholders if not managed carefully. Laser Photonics is traded on the Nasdaq under the ticker symbol LASE, so all these movements affect its stock performance directly. It's also worth noting that Laser Photonics is classified as an emerging growth company. This means they have certain flexibilities in how they report their financials and comply with regulations, which is pretty common for newer companies, but something investors should always keep in mind. Now, what are the bigger implications of this deal? Let's look at what the company is agreeing to. This convertible note deal is essentially a way for Laser Photonics to raise capital without immediately diluting its stock price through a traditional share offering. They are taking on debt, but with the option for that debt to convert into stock. If the company's stock price rises above 14.34, Hudson Global will likely convert the note into stock, making a profit on the difference. This is a win-win if the company performs well. However, if the stock price stays below 14.34 or even drops significantly, Hudson Global might choose to be repaid in cash plus interest. This could strain the company's cash flow if they don't have enough. Those monthly payments of nearly $4,600 plus interest are a fixed cost they have to manage. The signing of this report is dated September 3rd, 2025, and it's signed by Wayne Tupuola, the president and CEO, indicating this significant financial move was officially authorized. So looking at this deal from a strategic standpoint, Laser Photonics is getting funds which is crucial for growth and ongoing operations. They're betting on their stock price increasing enough to make the conversion option attractive to Hudson Global. However, there are always risks. If the company's performance falters, the convertible nature of the note could become an expensive burden. They're essentially getting these funds with an implicit promise that their future stock value will justify the conversion. Now for our take. This type of financing is a double-edged sword. On one hand, it provides capital with potentially less immediate dilution than selling shares directly. On the other hand, that 4.234 conversion price sets a target floor for the stock. If the stock can't clear that hurdle, the company might face cash flow issues or a more complex financial situation. The 12% interest rate is also not insignificant. The company's future performance is key here. They need to demonstrate that their industrial laser systems business is growing and profitable enough to support a higher stock price. If they can achieve that, this financing could be a very smart move, enabling them to fund growth without crippling the existing shareholders. But if they stumble, the convertible debt could become a significant problem. We'll be watching Laser Photonics closely to see if they can navigate these financial waters effectively and turn this capital into tangible growth. What's your perspective on this convertible note financing? Did they make a smart move, or is this a potential pitfall? Let us know your thoughts in the comments below if you found this breakdown helpful. Give this video a thumbs up and subscribe to Corporate Decoder for more in-depth financial analysis. For even more insights and to connect with other viewers, join our Discord community linked in the description. Thanks for watching, and we'll see you in the next one.